Wall Street is still worried about a banking crisis. How did we get here? So, this is actually bigger than startups and Silicon Valley VCs. To understand how this happened, we gotta talk about interest rates. Since 2008, they've been pretty low, sparking a venture capital boom and some real silliness. There's been a lot of froth for a long time, and it got worse during the pandemic when the money printer went brrr. Meme stocks, crypto boom, SPACs. Thank Federal Reserve Chair Jerome Powell, who settled on 0% interest rate policy, ZIRP. So, if you are, let's say, a bank specializing in startups, do you know what ZIRP World does to you? Well, my children, according to the most recent annual filing from SVB, bank deposits grew as IPOs, SPACs, VC investment, and so on went on at a frenetic pace. And because of all these liquidity events, congrats by the way, no one needed a loan because they had all this cash. This is a sort of problem for a bank. Loans are an important way to make money. So, as explained in more detail by Bloomberg's Matt Levine, Silicon Valley Bank bought government securities. This was a fine and steady way for SVB to make money, but it also meant it was vulnerable if interest rates rose, which they did. Powell started cranking up rates to slow inflation and told Congress this week that he expects to let them get as high as 5.75%, which is a lot higher than zero. Hello everyone and welcome back to the channel. In today's video, we'll cover the popular, almost bankrupt Silicon Valley Bank and how Wall Street is on its toes with all that unfolded. But first, make sure to subscribe to the channel for more similar content. Now let's dive in. Here's the problem for Silicon Valley Bank. It got a bunch of assets that are worth less money if interest rates go up. And it also banks startups, which are more plentiful when interest rates are low. Essentially, these bankers managed to put themselves in double trouble, something a few short sellers noticed. Pity the shorts. Despite being right, they're also fucked because it'll be hard to collect their winnings. The hope was that the Federal Reserve and U.S. Treasury's intervention to make depositors of Silicon Valley Bank whole would act as a definitive circuit breaker for what threatened to escalate into a full-blown banking crisis. And while the nerves of depositors have been calmed, shareholders of certain lenders were on edge as regional banks got hammered overnight. As Wall Street opened, U.S. regional banks came under selling pressure. The U.S. regional bank ETF slid 13% on the open as some lenders, such as First Republic Bank, plummeted 62% by the close. One financial institution, which perhaps had an understated systemic importance, was the focus of particular anxiety at the weekend, and those fears proved founded. Charles Schwab, the giant brokerage wealth management platform, closed about 12% lower overnight. Schwab shares have been down about 25% after it reassured investors it had sufficient liquidity to meet any deposit withdrawals. Schwab, which owns a bank, appeared vulnerable to a crisis of confidence, according to analysts, because of several movements on its balance sheet. Over the year, its cash balance more than halved from $91 billion, $137 billion, to $40 billion, while its liquid available for sale assets fell from $272 billion to $147 billion. Its so-called hold-to-maturity assets, which it does not have to mark to market, ballooned by $170 billion to $173 billion. Meanwhile, its deposit balance slid $100 billion to $366 billion, while short-term borrowings have increased from $4 billion to $17 billion. Schwab also has a modest capital ratio at 6.5%, with $35 billion of capital held against $551 billion of assets. Given its large unrealized losses, this has made some investors and perhaps regulators anxious. The institution is losing deposits while it moves more of its assets into its hold-to-maturity book. As its liquidity depletes, Schwab has been forced to increase short-term borrowings, a move that has pressured margins. Schwab, like many brokers, should be a major benefactor from higher interest rates. This is because it gathers deposits from its retail investor client base, for which it pays very little, who hold cash when they're deciding what to buy. It can then invest that money at increasingly higher yields in the market to earn a decent spread. There are similarities to SVB in that the drain of deposits has placed strain on its liquidity and made its large unrealized losses harder to ignore. But the reason Schwab has been losing so many deposits is different to that of SVB, which found itself overexposed to cash-burning venture-backed companies. Schwab is most likely losing deposits because its customers are taking advantage of its technology to easily switch out of cash and into higher yield money market accounts to take advantage of the higher upfront yields on these relatively safe assets. Our balance sheet reflected the reaction by our clients to the dramatic increase in rates. The company's chief financial officer, Peter Crawford, said in January, as they move some of their uninvested cash off our balance sheet into higher yielding alternatives, oftentimes with our active help. On Monday, Schwab was pointing to this granular deposit base to assure investors it had ample liquidity, comments that triggered a relief rally. Schwab is an institution that is far more pervasive than SVB and has just shy of 34 million accounts, which Americans use to invest and store their wealth and assets of more than $7 trillion. It has an ability of systemic importance, and regulators are clearly hoping that doubts about its ability to meet any cash calls can be met. Ironically, Schwab and other embattled regional banks face salvation from this circularity of this crisis. The chaos was triggered by solvency doubts arising from large and growing losses on their safe bond investments as short-term interest rates have surged. This, in turn, has created an almighty rally in bonds as traders bet the Federal Reserve will be forced to call off its fight against inflation. As a result, a fair chunk of those unrealized losses have been cured by enormous trading profits. What does this mean for startup land? The venture capital ecosystem exists because, once upon a time, banks wouldn't loan startups money. Think about it. A 23-year-old nerd slapping together a startup in someone's garage or whatever usually doesn't own anything they can put up as collateral against a loan. One way that Silicon Valley bolstered startups was by offering risky forms of financing. For instance, the bank lent against money owed to a business's accounts receivables. Even riskier, the company lent against expected revenue for future services. Silicon Valley Bank also offered venture debt, which uses a VC investment as a way of underwriting a loan. And it worked! These kind of products helped build Silicon Valley into the powerhouse it is now, says Jonathan Hershen, who's done high-tech PR for the last 30 years. Startups aren't the only ones who need to raise money. Venture capitalists do too, often from family offices or governments. Silicon Valley Bank invested in a number of VCs over the years, including Excel Partners, Kleiner Perkins, Sequoia Capital, and Greylock. This kind of gets us to one of the CVB's key problems. Silicon Valley is a small town, and while that meant SVB was the cool banker for the tech and life science startups there, that also meant its portfolio wasn't very diverse. The incestuous nature of Silicon Valley startups means gossip is a contact sport, because everyone here is hopelessly entwined with everyone else. That's all from us today, folks. For more similar content, make sure to subscribe to the channel, and I'll see you in the next video.